Good evening, ladies and gentlemen, and welcome to our class on retracements and reversals. Now, tonight's class is sponsored by CMS Trader, one of the world's leading platform providers. And if you'd like, you can go to www.cmstrader.com and open a demo account during this class and actually use their charts to follow along and see how you understand and determine whether you're looking at a retracement or a reversal. Now, CMS Trader is a regulated provider, so I am required to give you a risk warning. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. Now, if you go to www.cmstrader.com and just click on the buy or the sell button, you just have to pick out a password and you'll have an instant demo account. And like I said, you can then use the charts right there to follow along with tonight's class. Now, when you trade with CMS Trader, you get impeccable service. You have no dealer intervention. There is no conflict of interest between broker and trader. And they offer many tools and facilities to help you learn to trade better. You get any type of account you want. You'll get unlimited access to all their different platforms. You'll get free daily signals. You get up to the market updates and technical analysis. And you'll have multilingual customer support and account managers. You will get superior execution quality of all your trades and all account types. You can use their huge range of assets to trade. You can trade Forex, CFDs for stocks, commodities, indices from around the globe. You can also use their watch, copy, profit, which is their social trading, where you can find one of their best traders and just follow along with them and duplicate their trades with one single click to increase your profits. You can also use their independent courses to become an excellent independent trader. There's no charge for any of their education. They offer one-on-one sessions, ebooks, video tutorials, both for advanced and beginning traders. Now, let's get started talking about what retracements and reversals are. Now, in regards of what market you're trading in, whether you're trading stocks, whether you're trading CFDs, whether you're trading ETFs, whether you're trading ICOs, whatever you want to trade, you have to be able to spot when a market is going to continue in its current trend or when it's going to reverse itself. And the ability to point out the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement or a potential reversal. And that can turn winning trades into small profits and magnified losing trades, because what most traders find itching is the markets don't move. Traders would like the markets to move just like that in this long straight uptrend, but they don't. Markets push and surge, push and surge, push and surge, push and surge. They move in peaks and valleys. And what happens is too many traders panic in an uptrend when they see this valley developing, but they're going to have constant valleys. And a normal good uptrend is a zigzag. There's rules to that zigzag, but it's the way a market will move. You need to be able to enter a market down here and exit the market here to make that full range of pips, instead of exiting the market here because you're panicking and you haven't even covered your costs of your trade. Or jumping in the market here when it's actually a reversal, not a retracement. Or in the middle of an uptrend, get in it here instead of down here. So you need to be able to maximize your profitability. And you need to be able to exit the market quickly when that trend is moved into a reversal. So today's webinar is to provide you with some information and knowledge needed to accurately determine whether an asset trend is forming a retracement or preparing for a reversal. Okay. So first, we need to define what a retracement is. Okay. So let's start off with some definitions. Retracements are momentary reversals that often occur during longer trends. Unlike reversals, though, retracements show a continuation of an opposing trend within a targeted asset's price action. As you can see in the picture on the right, there are a couple retracements that take place and occur throughout a prolonged period of trade. So if you think of a reversal as an opposite move of where the current trend is, you have small reversals because a retracement is then a small reversal, but then the price is going to retrace and gain more momentum. Okay. Small reverse and then gain more momentum. In other words, peaks and valleys, pushes and eases. Okay. A retracement is an exit from the market. A reversal is an exit from the market when the market itself, the momentum of the market, or the attitude of the market has shifted and the market is reversing. So if you think of as a retracement as just a tiny little reversal, or if you stop thinking an uptrend, the buyers just have exhausted themselves. They haven't given up. They just are taking a breather. So they push, they fight, they climb, they climb. Well, then they climb up to the top of the ladder or the top of the stairwell, and this is the landing, and they take a breath, they go down and get a glass of water, and then they come back fully charged and push up. Well, this is what you want. This is where you want to be trading. Okay. So you have to be able to determine that it's a retracement, not a reversal. Now, again, unlike reversals, retracements show a continuation of an opposing trend within the targeted asset's price. So one of the first rules that we look at in a retracement is each retracement can't make lower lows than the previous retracement. So here we had a retracement of this price move up. It eased back down to here. When the price moves up again, if it's retracing, it cannot come ever below this level. Then it retraces up. When it retraces again, it cannot come ever. The lowest low of this trade cannot come below that low. Okay. So each time you want to make higher lows. When you see that happening, you know it's a retracement, not a reversal. And that means don't panic. And in fact, if you were looking to enter the market, that is a very good entry point to begin to enter the market for an uptrend, or if the market's flipped over, a reverse, the reversal. Whereas reversals are temporary changes in an asset's trend which occur over a short period of time. Oftentimes, the reversals can last minutes, hours, or days, but it just depends on what time frame you are utilizing on your charting solution. Reversals are oftentimes drastic and do not represent the long continuation of an opposing trend during the asset's price action like seen with the retracements. So, I'm sorry, I just want to get my marker off of here. Now, Wall Street is chock full of idioms, perhaps none so broadly quoted as cut your losses short and let your winners run. And that's very important. You've got to be able to let your winners run. If you can't make the maximum amount of pips per trade, then you're eventually going to lose because your losing trades will outnumber your winning trades, and you'll have bigger losses than your profits because you have to know when to let your trade run. Now, this is easier said than done. But how, in fact, is an investor to know whether a stock is merely retracing against its existing trend or if the trend is an outright reverse? Successful investing is predicting on knowing the answer to that question. So there are some things we want to look at, and we can set these in some type of a decision-making system. Okay. And we want to look at several things depending on what type of asset we're looking for. But the first thing we want to always look at is volume. Okay. If volume isn't telling you the right story, like when prices are moving up steadily, volume should be moving with those prices. If volume starts to decline while a trend is moving up, means that the buyers are leaving the market. Not in that little retracement. Overall, the buyers are leaving them. That means they're no longer strongly believe in that trend. Okay. Whereas if the volume maintains its level or moves flat but isn't decreasing, then you have a retracement, because what's decreasing a little or moving it from the move, you had the move up when the buyers were in the market, and then you see it flatten down a little, is because you have a lot of people small traders taking their profit. If you start to see a big shift in volume, that starts to tell you institutional traders are trading off large blocks of assets. Money flow is a little bit more difficult to assess unless you're using particular indicators that track money flow. But then chart patterns, few if any reversal patterns, usually limited to candles. That means you're not seeing lots of reversal patterns. Okay. Whereas if you have a true reversal, you'll start to see double tops or double bottoms or other types of indicators giving you reversal patterns. Shorting interest. Now, if we're in an uptrend, we may see increased. If you have retracement, you're not going to see any change in shorting interest. If it's a reversal, you're going to see growth in the amount of people shorting that asset, or the reverse if you're in a downtrend. Then the fundamentals. Basically, when you're in a retracement, there's been no shift in fundamentals. There's been no news. There's been no economic events. There's nothing to change it. Whereas in a reversal, we get a change or a speculation change of the overall fundamentals. Okay. Recent activity. We want to look at the recent activity and be able to analyze what's going on. And lastly, candlesticks will help you a great deal. There are many patterns that will give you indecision candles. Okay. What do we have? We have dojis. We have all kinds of indecision. When the open and the close in a candle is relatively the same, it's telling you of indecision in the markets. Spinning tops are a good one. Okay. Whereas if you're looking at a true reversal, you'll see engulfing patterns, bearish or bullish, depending on what you're looking at. You'll see three soldiers or other similar patterns that show you hardcore reversals, three black crows, three in and outs. And you can look for these patterns to occur when you don't have any of them, but you need to be able to compare. So when you see the price easing down in an uptrend, you need to pull out your little diary and say, okay, let's look and see if any of these are existing, and let's see if we can determine whether this is a retracement or a reversal. So whenever a price reverses, most traders and investors are faced with a tough decision. You have three options. Can you hold your asset through the sell-off, which could result in the large losses if the retracement turns out to be a larger trend reversal? 2, sell and rebuy if the price recovers. And unfortunately, this is what too many people do, which is definitely results in money wasted on commissions and spreads. This may also result in missed opportunities if the price recovers sharply. 3, sell permanently, which could result in a missed opportunity if price recovers. By properly identifying the movement as either a retracement or a reversal, you can reduce costs limit losses, and preserve gains. Now, traders have an expression for attempting to pick a market top or bottom. They call this trying to catch a falling knife. As the expression implies, it can be downright dangerous and if not normally recommended. But here is a risk-free method to help lower the risk. Now, retracements are healthy. A good market, a good strong trend will have continuous retracements. Okay, and we should see this in a nice, beautiful uptrend. Again, push and ease, push and ease, push and ease. And look at the pattern we see develop. Okay, beautiful. Low, higher low, okay, and they stay moving up. And this is the zigzag pattern, or the peaks and valleys pattern that we should see in all market trends. Now, it doesn't mean you can have weak trends, you can have hard trends. You're not always going to see this, but this is what you should be looking for. The market in general can become tired of moving in the same direction. It takes a lot of work and money to send assets to higher highs. When the price gets too high, buying pressure runs out and the money dries up. When demand dries up, price begins to fall and causes the charts to head south. This causes the security to become more appealing to prospective buyers. So in other words, when we see price moving up, at some given point, the buyers just get tired. Okay. When the price eases off, it attracts more buyers into the market because they still firmly believe that the market's going to continue moving up, but they thought the asset was too highly priced to enter here. So they look for a point where the buyers are looking for a point to re-enter the market and push it back up. As the price becomes more appealing at a lower point, these new buyers step in, creating demand, and once again, price begins another leg higher. What I've just described is a retracement. Retracements are healthy functions of a solid trend and are the proper time to enter a position on a trading stock. This is where you would want to enter a position. When you've confirmed that it's a retracement and the market starts to move back up, this is the point you want to enter a market. Remember, in an uptrending market, you do not want to trade or be selling short. You only want to trade with the trend. So you're looking for entry points in an uptrend. Then you're going to look for exit points, but you're not going to, you can never predict that this is the top, so you're going to sell here. Don't go that way. So you can see that after the retracement, a healthy part of the trend, the asset was unable to push to a higher high. Instead, the security rolled over and created a lower high. A lower high is unhealthy. So in other words, we can see it on the candlestick. Hold on, let me get my marker on here correctly. Pushed up. It was not able to make the higher high and bounced off, came down, and still was not able to make this high, could not exceed that high. So that's telling you the buyers came back in, new fresh buyers came back in, but they weren't able to hold the momentum. Okay. They weren't able to rally the market back up. So what we have is a lower high than the previous high. That's a big forewarning. A lower high is unhealthy, but it is not the end of the bullish trend. It is possible that after setting a lower high, the stock could retrace again, never setting a lower low and then push above the previous high. So this is one of the reasons you do not want to enter the market here. Okay, you don't want to trade against the trend. But the nail in the coffin of a bullish trend is the establishment of a lower low. Okay. What we have is now we've come below the low. Okay. And now that is telling you you are in a full reversal. Okay, so let's set some guidelines. So let's put some rules on this. Reversals are defined as a change in the overall trend of a price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal also occurs. Now tonight, whatever we're talking about is exactly flip-flop, because the same holds true in an uptrending market as it does for a downtrending market. It's just reversed. So what should I do? When faced with a possible retracement or reversal, there's only three options you have. One, if you're in a position, you could hold on to your position. This could lead to losses if the retracement turns out to be a longer term reversal. But this is the point that you need to look very closely at your stop losses, your take profit points, and closely watch that asset. Two, you could close your position and re-enter if the price starts moving with the overall trend. Of course, there could be missed opportunities if the price sharply moves. And three, you could permanently close your position. But be prepared, because reversals can happen at any time. Choosing the best option isn't always easy. Now, there are many indicators that we can put together to determine what we're looking at, because just a trend line alone doesn't tell you a whole story. Because you don't always, my examples are very nice when you have these hardcore downtrends, these reversals coming back up, and then a beautiful, this is beautiful. This is a beautiful retracement, but that's really easy to put on a chart. To get it in reality is a different thing. So we need to combine this with other tools like Fibonacci retracements, pivot point support and resistance levels, trend line support and resistance. We need to maybe look for chart patterns or for other strategies. Fibonacci retracements are an excellent tool for calculating the scope of a retracement. They are most widely used in the foreign exchange market, but they are also used in the stock market. To use them, simply use the Fibonacci retracement tool available on your charting software and draw the lines from the top to the bottom of the latest wave impulse. In other words, the latest trend. Now, we're going to briefly touch on Fibonacci retracements tonight, but we have whole 1 hour classes just on Fibonacci retracements. Okay. Fibonacci retracements are an excellent tool for calculating the scope of a retracement. They are most widely used in the Forex market. In most cases, retracements will stay above the 38.5, the 50%. Now remember, in Fibonacci, if you don't understand what Fibonacci retracements are, Fibonacci's are based on the golden rule. And this golden rule gives us certain numbers that exist in natural science everywhere. And these are the ratios between those numbers. And there are 4 strategic ratios. There is the 38-2 retracement, 50% retracement, which actually isn't a Fibonacci, it's just half the move, and a 61-8. So in other words, when prices moved, in this case, where you have to use the previous trend. So when prices move from, say, here to here, you would then use your Fibonacci tool and bring it forward, and this would tell you that what we would expect when price was then reversing. Okay, when price moved up here, we would expect it to continue up to one of these strategic levels, maybe 58, 61.8, 23.6, or to 0. Okay. We would then expect it to bounce back off of there, and here it came back to your 50 level, up to your 23.6 level, back to your 50 level, and then broke your 0 level, and essentially broke through its former high and continued its uptrend. So this was telling you, okay, now we had our retracements here, and see each one of these retracements. Okay. When we had price move up and then fall back down, and we wanted to determine whether it's a retracement or reversal, we would be looking very closely at the strategic 38.2 and the 50% level. 50%, we would start to panic that it's going into a reversal as opposed to. But once it bounces off that 50, we're then back into a retracement level. And again, it only hit the 23.6. So actually, you see it in a sideways congestion here. But then it hit that 50 level again and then started its surge upward. So this was a longer term retracement, but it was a retracement, not a reversal. So a Fibonacci tool can be combined together with that, and using the Fibonacci retracement levels help you determine whether you're looking at a reversal or a retracement. Another one is using pivot points. Pivot points are lines of support and resistance. Pivot points come from pivot point charts. And you can find these all over the internet. They're free. They're mathematical calculations. There's no secret to what pivot points are and what they are at the present. But they're lines of support and resistance. And these can be, if you go to investing.com and just go under technical analysis, click on pivot points, and you just make sure you use them in the same time frame you're using your chart for the same asset. It's going to tell you the next support and resistance level, 3 above and 3 below the current price. So we're having R1, R2, and R3, which are resistance 1, 2, and 3, and you have support 1, 2, and 3. We would then expect as prices moving up to break above. It will support the price below it if price is moving up, and then it will reverse off there. If you don't understand what support and resistance are, you should come to our classes. But pivot points will help you very well be able to predict whether you're looking at a retracement, because it will give you levels that you would expect to support that price. So when price is moving up, like we saw it here, it came back down to its lower support level, wasn't able to generate any momentum off of it, but it didn't break through it. Finally here, when it broke through it, we were kind of worried that we were going into a reversal. It bounced back up, came to that support level, which was its resistance, came above, but it wasn't able to go back up and break out into the uptrend for its next resistance level. And then here, it finally fell below to the next support level and kept breaking down. But if you combine those, if you're in an asset and you were in this asset, trading it here, okay, you wouldn't have exited here because you couldn't have predicted all this. But when it came down here and wasn't able to stay above the support level, or was able to stay above but not go anywhere, kept coming to the support level but going nowhere, then it broke below. At this point, you would probably be exiting that asset because staying any longer wouldn't have done you any good. So here, we are getting a confirmation of a retracement, but we're not getting a reversal, but we're not getting any reason to stay in the marketplace. Then you also have trend line support to help you determine whether you're looking at a retracement. Because if you have your proper trend line drawn on your chart, what happens is a trend line is always charting your lower lows, because a trend line can't be broken, because once it's broken, it is over. So price will move up, thrust up, come back down, push up, come back down. Now at this point, it's not making a lower low than it did here, because otherwise it would break the trend line. Push back up, came back down, push back up, came back down. Okay, so the trend line support line was supporting this. Now this is not a pretty trend. In fact, it's a very awkward looking trend that would have been very hard to trade, but you would have not, if you would have entered a trade here, there would have been no reason for you to exit it, and you could have eventually ridden that profit all the way up to that level. Okay. Because like I said, trend lines aren't always beautiful things. Finally, if a major trend line supporting the larger trend is broken on high volume, then the reversal is most likely in effect. Chart patterns and candlesticks are often used in conjunction with these trend lines to confirm reversals. Okay. Now, so what we'd be looking at is adding in chart patterns. Chart patterns have been established definition and criteria, but there are no patterns that tell you with 100% certainty where security is headed. After all, the richest man in the world would be a trader in that case, and would never be an investor. The process of identifying chart patterns based on these criteria is subjective in nature, which is why charting is often seen as more of an art than a science. But when we can see these specific patterns develop, they might give you some forewarnings, like a head and shoulders. Okay. When we see a head and shoulders and we see that right shoulder break that support line, or it's called the neckline, it's telling you that you have a good trend reversal, because it's almost a triple top or a double bottom, but it's a full head and shoulders. And then we also have other chart patterns like our ascending, descending, and symmetrical triangles. Two of the most popular chart patterns are reversals and continuations. A reversal pattern signals that a prior trend will reverse upon completion of the pattern, while a continuation pattern signals that the trend will continue once the pattern is completed. These patterns can be found across any time frame. So like we see in an ascending triangle, as price moves into that triangle, we're expected to break out and continue into that trend. The descending triangle, just the opposite. So remember, technical analysis is the study of historical price performance in an effort to predict future price performance. Price is the only accurate measure of investor sentiment. It is important at the intersection of supply and demand. Investor sentiment is at least and possibly a more important determinant of price than fundamental factors like earnings, revenue, profit margins. There are three important principles that govern all technical analysis. First, price is not random. Second, price anticipates fundamental changes. And third, the relationship between price and time is linear. Different strategies have varying degrees of success depending on where the market is in a bigger time frame. Technical analysis is a strong uptrending market will show the basing patterns are frequently broken to the upside, forming a stair-step chart pattern. In other words, the zigzags or the peaks and valleys you would expect in a good uptrend. However, the same trader who continues to use patterns without recognizing that the market has now lost momentum and is a basing phrase will not have the same success. Traders will find breakouts do not carry as far as many breakout starts to fail and become losses. Again, no single combination. What you're looking for simply when you're looking at a trend, a reversal, or a retracement, you're basically looking, if you're in the market, to determine whether you want to remain in the market and to stay in the market. Remember, you have your three options. So you want to know, should I be exiting this market or should I be staying in this market? Should I panic and sell? If you're looking to enter a market, is this a retracement or a reversal? If it's a retracement, okay, how can I enter so I can take advantage of its next move upward? So buy signals come at very specific times. That is after a pair breaks the correction pattern and the oscillators, like in this case, the MACD moves back above zero and ascends into buy territory. Okay. And this is what will happen when you have a reversal, a retracement ending. Okay. Now, of course, with any strategy, including symmetrical triangles, there is no singular perfect strategy can always guarantee profits. The major downside to a symmetrical triangle strategy is that the pattern does not occur every time. For example, if the waves that follow can see that there is no longer tops. So a symmetrical pattern is a pattern that develops in a chart in these movements, and it's when we have a very nice confirmed retracement that forms a triangle, and then we get the breakout, and we can actually measure the break, because the breakout momentum should be equal to the height of, and I forget what the word is for this distance of a triangle. So this is your breakout of that triangle, but we have to use it with other indicators. In this case, we're using MACD, which is also giving us a convergence, and we're getting our buy signal to enter the market here when we get the breakout from the triangle. So we had a beautiful retracement in an uptrend, okay, a confirmed triangle, a breakout of triangle, which is giving us a buy signal, okay, and would tell us to enter the market. Okay. If you were in the market here and you saw this, before you actually had the breakout, would you be panicking and selling? No, that's what you should be doing, is you should be remaining in the market. But trading from the symmetrical triangle pattern is a perfect way to trade, to find an entry point to take advantage of that bullish trend, and to get in there at that bottom of that retracement so that you can exit here and make the profit all the way to here. And it's called a symmetrical triangle strategy, or symmetrical triangle pattern. And so the chart shows the pair have continued above point B, which was our target. Yet the symmetry rule made us exit the trade early. Why? The idea is that when you have a triangle break that fulfilled a aforementioned condition, it tends to generate a move higher, at least the same height as the triangle for the point of the break. If, for example, the bullish trend would have been over, the pair would have topped out a little above B. So again, when you enter the market, you want to enter with your rules. And when you saw the symmetrical triangle, and you were trading the symmetrical triangle, and you were looking to enter the market, what you would be measuring is your target point would be this point, that equidistance from here to here. So when you had the breakout, this would have been your target point. Okay. You can get greedy and ride it all the way up to here, or if you use other strategies like, keep using your floating stop loss, moving your stop loss up so that once you hit your profit level, you stay in profit. But if you use a symmetrical triangle, you're already setting your take profit point at your B target, your stop loss here below your A, and you're entering the market here to take advantage of it, not being greedy. Okay. And this gives you a beautiful retracement. If you were in the market, you would just stay. But this is a perfect retracement in a perfect symmetrical triangle, which gives you a perfect buy signal. Now, there's all kinds of weird ones out there. I read this one just the other day when I was building this class, and some strategist out there came up with what he called a sushi roll. It is so complex that you would be buying and selling so many times that you would end up spending more money on spreads than you would ever spend on making trading. But he's out there selling it. It's called the Sushi Roll strategy. And it uses buy and sell signals generated by retracements. Okay. But it's a period of 10 bars when the first 5 bars are confined within a narrow rating range, engulfs the second, and rolls up the pair. When the Sushi Roll pattern shows up in a downtrend, it warns of a possible trend reversal, showing that it's a good time to look for a buy, or at very least exit a short position. If it occurs during uptrends, the trader gets ready to sell. The second trend reversal pattern for a longer term trader is what he called the outside reversal week. This guy just came up with crazy stuff. But remember, keep calm. Eat your lunch. Don't panic when the markets ease back down. Be able to tell whether it's a retracement or a reversal. Always trade with the trend and capitalize on those retracements as good entry points, but be able to tell if you have a full core reversal so that you know to exit the market on time. Now, there's many false signals. Remember, we went through our little chart earlier, but even a retracement can meet all the criteria outlined in our outline and may turn into a reversal. You could estimate retracement levels using technical analysis and place your stop loss points just below these levels. Alternatively, you can take you can place your stop loss just below the long-term support trend line or the moving average. Ideally, you want to do what is to lower your risk of exiting during a retracement while still being able to exit a reversal in a timely manner. In conclusion, as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon and missing opportunities, holding on to losing positions, and losing money and wasting money on commissions and spreads. By combining technical analysis with some basic identification measures, you can protect yourself from these risks and put your trading capital to better use. And on that note, I'm going to say goodnight to everybody. This class has been recorded in about 24 hours from now. You can use the link you had for tonight's class and watch the recorded version. Thank you very much, and go to www.cmstrader.com and set up a demo account. Use their charts and see if you can see some retracements and patterns. Practice these. You'll be able to see them no time flat. And remember, they'll help you from losing money. And remember, risk is always the most important thing. So at least you'll be able to identify when the markets are reversing and get out of them. So thank you very much for joining us tonight. Have a great trading week, and thank you for being part of the Investing.com family.